Good morning, ladies and gentlemen, and welcome to the audio conference call that will review Embraer's third quarter 2021 results. Thank you for standing by. At this time, all participants are in a listen-only mode. Later, we'll conduct a question and answer session, and instructions to participate will be given at the time. If you should require assistance during the call, please press the star key followed by 0. As a reminder, this conference is being recorded and webcasted at ri.embraer.com.br. This conference call includes forward-looking statements or statements about events or circumstances which have not occurred. Embraer has based these forward-looking statements largely on its current expectations and projections about the future events and financial trends affecting the business and its future financial performance. These forward-looking statements are subject to risks, uncertainties, and assumptions, including, among other things, general economic, political, and business conditions in Brazil and in other markets where the company is present. The words believe, may, will, estimate, continues, anticipates, intends, expect, and similar words are intended to identify forward-looking statements. Embraer undertakes no obligations to update publicly or revise any forward-looking statements because of new information, future events, or other factors. In light of these risks and uncertainties, the forward-looking events and circumstances discussed on this conference call might not occur. The company's actual results could differ substantially from those anticipated in the forward-looking statements. Participants on today's conference call are Mr. Francisco Gomes Neto, President and CEO, Mr. Antônio Carlos Garcia, Chief Financial Officer and Procurement, and Mr. Eduardo Couto, Director of Investor Relations. I would like now to turn the conference over to Mr. Gomes Neto. Please go ahead, sir.
Good morning, and thank you all for joining our third quarter call today. I hope that all of you are well and safe, and I thank you for your interest in our company. As you will see later in Antonio's presentation, our results for the quarter were in line with our internal expectations, and with cash generation coming in better than planned. The Q3 results continue to show that our strategic planning and its execution are showing tangible positive results for the company. Before we go into more financial details on the third quarter, I'd like to touch on some highlights in each of our business segments. In the commercial aviation, we delivered 9 E-jets in the third quarter, and so far in 2021, we have delivered 32 aircraft in line with our forecast for the year. We continued to show positive momentum on the order front, with another 16 aircraft in a firm order with SkyWest, leading to book-to-bill in excess of 2-to-1 this year. Also, within commercial aviation, a milestone was reached when Swiss airline Helvetic Airways performed the first revenue-generating flight of the E2 to London City Airport. The ability of the E2 to attend to this strategic airport will allow for further penetration of this family of jets in the European market. In executive aviation, we continue to see very good momentum on the demand front, and in the third quarter, this business registered records. Further, our portfolio of finance Embraers is sold out through 2022 and into the first quarter of 2023, leading to book-to-bill in excess of 2-to-1. And this doesn't even include the deal we announced at NBWA in Las Vegas of a $1.2 billion sale of up to 100 Phenom 300E aircraft. Finally, we delivered the 1,500th Embraer executive jet in the third quarter, showing our rapid growth within this industry, as it only took us 20 years to reach this milestone, when the rest of the industry players took on average 34 years to deliver that many aircraft. On the next slide, we start with the highlights from the defense and security. During the third quarter, our subsidiary ATEC delivered an updated version of the Brazilian air traffic management system, which will be able to unify all flight plan processing in Brazilian airspace. Also, we delivered 6 Super Tucanos to different customers, underlining the continued demand we see for this market-leading light attack and training aircraft. We also continue to negotiate the C-390 production contract with the Brazilian Air Force, and we will share additional information regarding this matter once it becomes available. The services and support continues its recovery, along with commercial and business jet traffic globally, and we recently were able to attend the MRO Europe event in person a few weeks ago. During the event, we had several sales announcements, including a pool program support contract with KLM Cityhopper for its entire planned E195 E2 fleet, which at present is expected to be the largest E2 operator in Europe. We are also proud that the Executive Aviation Services placed first again in ProPilot's product support survey for 2021 and was third place in the AIN survey. Finally, our OGMA MRO subsidiary in Portugal was honored with a top 10 ranking of MRO service centers in Europe for 2021. A great sign as we expect to significantly grow this business in the coming years with exciting new business to ramp up. On the next slide, with respect to innovation, we continue to make progress on partnerships in the urban air mobility ecosystem through our subsidiary EVE, in a segment with strong growth potential in the years to come. Further, our Embraer X signed a multi-year agreement with Republic Airways for the use of Beacon's maintenance coordination platform. Although currently not very large in terms of financial results, we see a very interesting opportunity for Beacon to grow and add new customers over the next few years. Embraer X also announced a partnership with Pika, a Silicon Valley company, to accelerate the future of autonomous aerial agriculture operations. This quarter, we are going to start sharing some highlights regarding enterprise excellence. We reached the lowest inventory level since 2018, with a reduction of 22% in the last 12 months. In terms of operational efficiency, we reached an increase of 6.5%, and also a reduction over 10% in the production lead time of our aircraft. I will now hand it over to Antonio to give further detail on the financial results, and I will return in the end. Thank you.
Thank you, Francisco, and good morning, everyone. I would like to start with our backlog. We ended the third quarter with a backlog of $16.8 billion. This is up 20% in 6 months and is the second consecutive quarter-over-quarter increase this year. Looking at each segment, we have a good sales activity in our commercial aviation business, with another 16 firm orders from SkyWest, bringing total firm orders this year to 64 commercial jets. In executive aviation, a strong backlog continues across the entire portfolio with record third quarter sales. and a book-to-bill ratio in excess of 2 to 1. Backlog in service and support also grew from prior quarters level. In summary, our backlog has reached levels not seen since 2019. This gives us confidence our Fit for Growth plans are working and revenue and profitability will continue to increase. Moving to deliveries. In the third quarter, we delivered 9 commercial jets and 21 executive jets for a total of 30 aircrafts during the period. The 9 deliveries in commercial aviation represents a 29% increase compared to the third quarter 2020. Year to date, deliveries were at 32, a 100% increase over the same period last year. Of the 32 deliveries, 17 were E2s. Sales continue to perform very well, showing a recovery in our core markets. Executive aviation delivered 14 light jets and 7 large jets, for a total of 21 aircrafts in the third quarter. Year to date, deliveries were at 54, a 25% increase over the same period last year. We expect these positive trends to continue with 2021 deliveries of commercial aviation jets reaching between 45 to 50 aircrafts and executive jets between 90 to 95 aircrafts by the end of this year. Turning to net revenue. Third quarter net revenue was $958 million, up 26% from the same quarter last year. Commercial aviation revenue growth was driven by higher deliveries, while executive aviation growth was due to a more favorable mix of deliveries. Service and support growth was due to the expanded commercial, executive, and defense services. Defense also posted a revenue increase due to advances in our main programs and the deliveries of Super Tucanos. Year to date, net revenue was $2.9 billion, up 50% from last year. We had solid revenue growth as all 4 business units posted higher third quarter and year-to-date revenue compared to 2020. We expect fourth quarter 21 revenues to remain strong, and we expect to end this year between $4 to $4.5 billion in revenue. Looking at SG&A, SG&A continues to trend favorably over the last 7 quarters. Year to date, SG&A was down $48 million or 15% compared to the same period in 2020. As a percentage of revenue, year-to-date SG&A was at 9.1% compared to 16.1% in the first 9 months of 2020, down a full 7 percentage points. Selling expenses was up due to increased sales and market activities, demo flights, and in-person customer engagements. Although the trend is up, selling expenses is far below 2020 levels, due to our focus on more cost-effective ways to reach our customers. As a percentage of revenue, year-to-date selling expenses was 5.2%, less than a half of the 10.8% level in the same period of 2020. General and administrative expenses were 36 this quarter, equal to the average of the last 7 quarters. As a percentage of revenue, G&A has held steady at 4% in each of the 3 quarters this year. It's important to reinforce we remain highly focused on SG&A efficiencies and apply lean principles to our SG&A functions. Move on to Ebit and Ebitda. We are very encouraged by the continuing improvement in margin performance for the company. For the third quarter, On a consolidated basis, our adjusted EBIT margin was 3.7%, and our adjusted EBITDA margin was 8.3%, both up over 9 percentage points compared to the same quarter in the prior year. Year-to-date margins are similar, with adjusted EBIT at 3.8% and adjusted EBITDA at 8.9%, both above last year. On a dollar basis, year-to-date adjusted EBIT was $111 million compared to a loss of $177 million in 2020. And adjusted EBITDA was positive $258 million compared to a loss of $63 million in 2020. In our business segment, adjusted EBIT margin for the quarter were as follows. Commercial aviation was at 4.5%, improving from last year on higher deliveries and improved mix. Executive aviation was at 6.7%, driven by robust price discipline and consistent profitability. Defense and security was at 10%, resulting from a good mix of Super Tucano and KC deliveries. Service and support was also at 10.8%, with improved service contract performance. Additional expenses related to reintegration costs, ongoing arbitration costs, and other no-business related costs explain the total company margin is slightly below the business segment average. These improvements on EBIT and EBITDA margins are result of our Fit for Growth initiatives and enterprise efficiencies. This next slide shows our adjusted net income. For the quarter, adjusted net income was a loss of $4 million or 18 cents per ADS. Although negative, net income is trending up on a trailing 12 months basis, driven primarily by revenue growth and corporate efficiencies. And as our top line grows, our fixed cost leverage and financial leverage will improve, providing additional positive impact on earnings. Moving on to investment and cash flow. I'd like to first highlight our remarkable cash flow recovery. Third quarter adjusted free cash flow was a positive $21 million, which was the first time in more than 10 years we generated positive free cash flow during the third quarter, given the seasonality of the business. More efficient inventory management, better production planning, and strong sales and executive and commercial, and the down payments associated with the sales have led to our positive cash flow in the quarter. On a year-to-date basis, our adjusted free cash flow was negative $160 million. Although negative, this is far better than where we were this time last year. Looking to the fourth quarter, we expect these positive cash flow trends to continue. So today we are taking the opportunity to increase our 2021 free cash flow guidance to positive $100 million or better. We are very happy that only 1 year after the worst downturn in the aerospace history, Embraer will generate positive free cash flow, emphasizing not only our top line recovery but also results of our cost and working capital initiatives. Now to investment. Our total investment were $56 million in the third quarter and $145 million year to date, both in line with last year. This is important because it shows we continue to balance the need to invest in our future with the need to preserve cash. This next slide shows our cash and liquidity position. We ended the quarter with $2.5 billion cash and cash equivalents, a slight increase from the prior 2 quarters. Our debt balance was at $4.3 billion, with net debt of $1.8 billion. Both are a slight decrease from 3 months ago. Our average debt maturity decreased to 3.8 years. We expect to continue to generate cash in the fourth quarter and beyond, so our leverage will naturally decrease. We remain focused on generating cash, reducing our debt level, and improve our credit metrics. And of course, lower debt levels we reduce our net interest expenses and have a positive impact on net income. Finally, as I mentioned earlier in my remarks, we are increasing our free cash flow guidance to positive 100 million or better. Guidance in all other metrics remain unchanged. With that, I conclude my presentation and hand it back to Francisco for his final remarks. Thank you very much.
Thanks, Antonio. The third quarter and year-to-date results reinforce our confidence in our strategy. During the last 9 months, we have just seen the net revenue was up 50% from last year, as G&A expenses down 15%, and adjusted EBITDA at 8.9%. All that means focus and discipline in executing our long-term strategic plan. In a year of recovery, on top of sales and deliveries, the efficiency gains projects have proved to be a key element in improving the company's performance. The updated guidance with a positive free cash flow for the full year shows not only the good momentum of the company, but also the combined focus on the top line and higher profitability. Regarding ESG practices, we are also making progress on our journey. This quarter, we announced new ESG commitments, which include to be carbon neutral in our operations by 2040, using 100% energy from renewable sources and sustainable aviation fuel in our own flights. We will also work together with suppliers and the whole industry to achieve a net zero carbon emissions aviation by 2050, developing products based on sustainable technologies such as electrification, hybrid propulsion, and hydrogen. A final note regarding innovation. This quarter, we were awarded by the largest and most prestigious finance newspaper in Brazil, Valor Econômico, as the most innovative company in the country among all sectors. It is an incredible recognition for all of those who work to make Embraer a place of excellence in engineering, innovation, and technology. Thanks to our great team for their focus and passion on creating disruptive and sustainable technologies and executing our strategic planning. And thank you all for your interest and confidence in our company.
Ladies and gentlemen, we will now begin the question and answer session. If you have a question, please press star 1. If at any time you would like to remove yourself from the questioning queue, press star 2. Our first question comes from Josh Milberg with Morgan Stanley. One moment, please, Mr. Josh. Florencia Torres with MetLife. You may proceed.
Hi, hello everyone. Thanks for taking my question and congratulations for the results. I have 2 questions. One is regarding cost. If you are expecting any issue regarding the shortage of supply that everyone is suffering in upcoming quarters, or any strategy in terms of inventories regarding that. The other one is regarding targets on leverage for next year, if you are expecting to back to the 3 times level. Thank you.
So for the first part in regards to shortages, just a moment. In regards to shortages, I would say we are for this to the end of 2021, We may have some issues, but the material is confirmed. Maybe they will not arrive in time. That's why we still keeping a range when we give the guidance. And for our production planning for next year, we also have the confirmation for our partners, our suppliers, but we are going to follow up in a daily basis because we know that the whole industry is being affected by the shortages. And what we are doing, to some extent, we are also cautiously building up some material, especially where we do see more risks associated with this shortage, especially for next year. And your second question, I was not able to understand. Could you repeat your
It's about the
second?
leverage, Antonio, if we expect to reach a leverage of 3 times next year.
We are confident that this year will be net debt per EBITDA around 4, maybe slightly better, and we are confident that we are going to reach the level next year at 3. That's more or less our planning. And just to remind, 1 year ago we were at 20, and we should close this year, I would say 4 or even slightly below, and next year having no doubts that we are going to reach the 3. Thank you.
Perfect. Thank you so much.
The next question comes from Josh Milberg with Morgan Stanley.
Hey everyone, thank you for the call and congrats on the results. I had several questions on the executive business, and just for starters, with that good book-to-bill that you mentioned and the strong backlog, I was hoping you could talk a little bit about the executive pricing environment. We've gotten some inputs from the industry folk in recent months suggesting some meaningful upward moves, but it would be good to get your perspective on that. And as a second question, you mentioned being at the Las Vegas exhibition, and I wanted to see if you could touch on the competitive landscape and if you're seeing any competitor product developments that could pose a threat longer term. Thank you.
Oh, thank you, Josh. So, I mean, the business jet industry has been really a good surprise for us, for all of us this year, right? I mean, the business jet industry is growing, likely to reach 10% year over year in 2021, and this is good for all of us. We have been doing very well with our team. I mean, enjoying this market with a good discipline in prices, so which has helped us. I mean, showing a good result in the executive. We do believe we are sold out until the first quarter 2023, as we said before. We have a great, I mean, regarding the competition, we do believe we have a great portfolio of products with the Phenoms. I mean, Phenom 100, the Phenom 300 that continues to be our best seller, but also doing very well with the Praetors, the 500 and the 600s. We do believe in the market. I mean, as you have been in Las Vegas, we do believe that we are going to have a soft landing of the demand from 2022 and 2023 onwards, with a growth, average growth closer to the pre-pandemic levels of 1 digit. But so far, I think we are doing very well in the executive market.
Okay, that's helpful, and good to hear that you see a soft landing, because this is an industry that's seen a number of false starts in recent years, and there's the issue, of course, of how much COVID has been boosting your performance there and the overall industry performance. If I might just squeeze one more question in on the commercial side, just wanted to hear a little bit about how your campaigns have been evolving there, and how you're seeing the 2022 delivery scenario at this point. Thank you.
Okay, still about the executive jet. I mean, we have all the reasons to believe that in this soft landing, I'd say, right? I mean, is the wealth, the global wealth growth that the economic activity and the market liquidity. Also, the pre-owned market, that is one of the lowest levels ever, right? We are at below 5% in the normal levels, 5% on the fleet in operation, and the levels, normal levels used to be, the double of that. And and also, the first-time users and first-time buyers in this market also are good indicators that we are in a different level. It's not we are going not only because of the COVID, but there are other reasons for that, right? Regarding the commercial, we are also, optimistic with the market. The E1, 100% of our E175 fleet is already back in service. And this aircraft has been fundamental to support the market recovery. So our market intelligence has indicated that there are over 500 aircraft in North America to be replaced in the next 10 years. And our E175E1 is the only scope compliant aircraft in production today. So good perspectives for the E1. And also the right sizing post-COVID is going to benefit our E2s. We have a strong sales activity. I could say that we have a triple-digit number of aircraft under activity commercial discussions, and also this increased pressure from environment CO2 reduction puts our E2 in a very good position as we have the most environmentally friendly aircraft in that category. So because of that, we are really optimistic also with the commercial aviation for the next years.
And you're saying that, and just to add a point here, on the E2, having this ESG angle, that very sort of angle does not in any way kind of pose a threat to the E1, just given that the lack of alternatives at this point, even with oil prices being where they are from your standpoint.
Could you please repeat that, please?
Well, I was just making the point that, you're highlighting the environmentally friendly, driver of the E2, and just wanting to raise the question of E1 being sort of a last generation aircraft and high oil prices today. That in your view does not in any way threaten, demand for the E1 just because there are no alternatives.
Well, I think short term is the perspective we have for the E1s, but in parallel we are still working in the new alternatives. The turboprop new generation is one of them. We have seen strong interest from customers on that project, and everything is going well for a business plan for that aircraft, to be approved by the second half of next year. And we continue
Wonderful.
with the E175 E2 as well. So we have to continue working that project.
Okay, really appreciate all the perspective.
And Josh, just to complement one point here, in regards to the planning for 2022, you saw in my speech we sold 64 commercial jets, and it should be something slightly above 60 aircrafts for next year, something like that. Just to give you a number, we're still confirming with the suppliers, with the customer, but just to give you a perspective, it's more or less where is yourselves next year.
Okay, that's good visibility. Really appreciate it.
Thank you, Josh.
Our next question comes from Ron Epstein with Bank of America.
Hey, good morning, guys. A couple questions. So the cash flow in the quarter clearly was good. Now, in the past, it's been lumpy. So, how should we think about cash flow going forward? Is this a trend towards better cash flow on a more consistent basis, or is this more of a one-time thing?
Hello, Ron. This is Antonio speaking. Thanks for your question. As I mentioned in previous calls, we do see I would say, the cash flow generation as a sustainable base. I would say in a middle-term perspective, we should be able to show free cash flow, I would say 50% of our EBIT for the first beginning. That's more or less the 100 million that we are disclosing right now. And assuming the growth path we are and the recovery we are, that should be more or less following for the coming years. It's more what our projections are telling us. We are, I would say, quite diligent with our investments, with new projects, even into more details and highly focused on cash generation for the legacy business. A new business, we need to find alternatives to not compromise the legacy business we have in the company here.
And
Got
if allow me to complement that, Ron, it's Francisco speaking now. We also continue to work on actions to reduce inventory, to increase the turnover of our inventories, and to reduce the working capital in our operations. So all of these activities combined with the growth will make us to believe that we will continue with this good performance in cash generation.
Got it. And when you think about EBITDA margins, how should we think about where those could go as you work through the efficiency programs? Is there sort of like a notional target we could think about as investors?
Ron, for sure, 2 digits and no-brainer. We are close to 8.9 year to date. That should be, I would say, in the long run, we do see ourselves between 10 to 15, but does not mean that we are happy with those numbers, but it's already a good sign for us. It's more or less in our long-term planning.
Okay, so if we were to think a range 10 to 15, that's a reasonable range and potentially maybe even higher depending on how things go.
Yeah, absolutely. And we do see the recovery in the commercial aviation slowing down, coming back 2023, 24. I would say it's more value to monetize, but it's going to take longer because of the recovery of the commercial jets.
Got it. And then maybe on that front, on the commercial jet front, what are you seeing in terms of, sales campaigns, activity? As we start thinking about 2022, how do you think that year could, and I know you haven't guided yet for 2022, so I'm not really asking you for that, but just broadly, do you have a sense on how 2022 from an order activity front could appear for the E-jets?
Well, Ron, I think as I said before, in the answer before, we see good perspectives for the E175 E1s because of the quick rebound in the U.S. market for domestic flights. Very good opportunities we have in the next years, and the E2s as well. As I said before, I mean, we are working in a lot of commercial campaigns, and this right sizing post COVID, this increasing pressure from environment, this puts our E2 in a good position. I mentioned also this first experience of the Helvetic Airways in the London City. I mean, many things are happening that we believe will put our E2 also in a good position for next year onwards. We are optimistic with both products.
Got it. Ron, I just want to come back to the EBITDA margin issue, and it's important to mention if you see the Q3, and we try to give you guys information in order that you do the math, because we do, as you know, we have some costs that we are handled in a central way in the corporation without affecting the margin of the business unit, like the integration of the commercial aviation, arbitration costs, and we are still restructuring the company. And I would say we are today without this already above 10%. But we are not adjusting because we don't want to disclose those numbers, but without this, we are already above 10% today.
Got it. And then maybe just one last question, if I may. On the there's been a lot of discussion around the potential of maybe a new turboprop and a new platform. Where does that stand?
Well, Rom, as I said before, I mean, we are seeing a very strong interest from customers. I mean, suppliers and also investors in that product, and everything is going very well for a business plan approval by the second half of next year. So we are also very optimistic with the development of this product, this new product.
Got it. Thank you very much.
You are welcome, Ron.
Our next question comes from Victor Mizusaki with Bradesco BBI.
Hi. First, congrats for the solid results. I have two questions here. The first one is related to guarantee deposits, right? I mean, we saw a material increase in the third quarter. So I'd like to know if it could make sense for us to assume that commercial aircraft delivers for 2022. I mean, if we compare what happened this year with guarantee deposits and deliveries, if we try to estimate what could happen in 2022, that maybe the company could deliver more than 60 aircraft next year, commercial aircraft. And the second question is related to provisions. I mean, the write-off that the company booked in the third quarter. When we take a look at the audit figures, we can see a write-off of 33 million reais. So I don't know if you can give additional details. Thank you.
Hello, Victor. Thanks for your question. Let's say start from the answer to the provision side. We have some movements in our obsolete material that we are selling right now. That's why we did an adjustment in Q3. It's not a big issue. It will come back in the coming months as soon as it gets the material sold and delivered. And I would say we do have a chance to be above 60, but we are continuous to discuss with our customer and especially the suppliers in order to make sure that we will be able to fulfill, because the situation is not, let's say, first starting different industry like automotive, but we are seeing right now that assuming that we are picking up, our competitors they are picking up, that we may see more restrictions that we are seeing today. But we do have space to be above 60, and we are going to give a guidance for 2022 in our next call.
Okay, thank you. And Antonio, if I may, just a quick one. You mentioned some expense with the arbitration process with Boeing. Can you give any kind of update on this matter?
Yeah, Victor, unfortunately, we are not able and allowed to give too much detail, and that's why we are not adjusting the cost, or you could do the math in a different way, but we are, what I can tell you, we are the process to continue, and next year will be more or less, I would say, a kind of important year for the arbitration, but it's going to take more 2 years, in my opinion.
Okay, thank you.
Welcome.
The next question comes from Marcelo Motta with JP Morgan.
Hi, everyone. Thank you for taking the questions. Two questions as well. First, if you guys could provide any update regarding Eve and the Ebitda business. I mean, we all know the material fact that, the negotiations are going. So just wondering how you guys feel about the negotiations. Is that there have been any bottleneck or anything that might be leading to a lower than expected conclusion for that? And the second question is regarding services and support. I mean, the segment continued to show a very strong growth, continue to have solid margins. You announced several agreements during the quarter. So just wondering if you guys can provide us some expectations on how much this line could grow, or how much those new agreements have been adding to revenues, or how much they could add in revenues, in the midterm.
Thank you, Marcelo, for the questions. The first one regarding if what I can tell you is that the negotiations with our partners Zanite are ongoing, but we cannot comment further. The company will keep the market informed of any relevant developments of this operation. About the second one, yes, you are right. I mean, our service and support area is doing very well. It's enjoying the return to operation of our aircraft, both in commercial and executive business. And we have good plans to grow further in that area, not only with Embraer aircraft market, but also in the non-Embraer aircraft market. We have, as we said in the previous call, we signed an important contract with Pratt & Whitney for the GTF engine maintenance in Portugal. It's a multi-billion contract, and this will allow us to grow that operation in Portugal, I mean, almost to triple their revenues in the next years, and this will help our service area at Embraer as well. So again, we have very good perspectives and opportunities to grow our service and support area.
Two-digit growth.
Yeah, two-digit growth every year, exactly, for the next 5 years.
Perfect. Thank you very much.
The next question comes from Noah Poponak with Goldman Sachs.
Hi, good morning, everyone.
Hi, Noah.
The commentary around being sold out next year on executive deliveries, at what level of delivery is that the case? And, that being sold into the first quarter of 2023, what do you want that lead time to be on a sustainable basis?
Noah, thanks a lot for the question. I mean, as I said, well, we are sold out through the first quarter 2023, actually. So our team is doing a great job enjoying this good momentum in the market. So we are working this production plan for next year, but we do believe it is still in another two-digit growth for next year. And as I said before, we believe in a soft landing of the demand from 22, 23 onwards. I mean, with a growth average closer to the normal pre-crisis, that would be a one-digit growth. And because of many reasons, as I said before, the wealth growth, the pre-owned fleet, and the new users and new buyers that are coming to this market. So this is our view on the executive market.
Okay. So you're planning for double-digit growth in units 2022 versus 2021?
Correct.
Can you tell us do you happen to have the number on the exact book-to-bill in executive in the quarter? I know you said it was over 2, but if you just happen to have the precise number, that'd be helpful.
Yeah, as I said before, it is in excess of 2 to 1, the book-to-bill.
Okay. And just to confirm the cash flow conversion target you're referring to, 50%, that's EBITA, EBITA, as opposed to EBIT or EBITDA?
Noah, for the first beginning is EBIT, operating results, 50% conversion for the first beginning because we are emerging with upside potential, but I do see today in a short term 50% what we generate in regards to EBIT, not EBIT.
50%, 50, yeah. free cash flow to EBIT.
Yeah, because okay. we are still having a higher interest cost in our company. It was a company 2-3 years ago at 6 billion revenue. Today we are at 4 billion revenue, and we still have this issue of being able to generate enough, I would say, business size in order to be able to compensate the interest. That's why I give you for
Right.
the time being these metrics, but I promise you guys I'm going to refine this number for the next call.
Okay, great. Okay, thanks so much.
Welcome.
The next question comes from Jack Ayers with Cowen and Company.
Hey guys, good morning. This is Jack on for Kai today. Thanks for the question. I guess just previously following up on the margin commentary, it looks like your guide implies EBITDA margin improving sequentially from Q3 to Q4. I guess if you could just talk about, or provide a framework for how we think about Q4 margin by segment. Like, is it defense, BizJet? I think your guide implies Q4 BizJet deliveries expanding here in Q4. If you could just provide some color around, the key sort of moving pieces around margin there would be helpful. And then on just backlog and book-to-bill, specifically this quarter, if you could provide what the defense and commercial backlog was, that'd be great. Thanks.
Thanks, Jack, for your question. If you see today or year to date, either EBIT or EBITDA margin, we are at I would say, the high end of our guidance. We do see for Q4 highly driven by executive aviation because we do have, I would say, more or less 40% of the delivery is going to happen in Q4. That's the first point. Commercial aviation, more or less close to break even. Then service and support also 10 with some upside potential. We do have the same defense at the same level, but we are cautious on the EBIT and EBITDA margin guidance because we are still negotiating with the Brazilian Air Force the current contract of the KC. We may have some risks that don't want to, I would say, saying that we are going to improve it because we still have a challenge here to end of this year. That's why we decided to keep the EBIT and EBITDA guidance at the same level. For sure, today we are much better, but in the high end, but we do have a challenge to end of this fiscal year. And in regards to the backlog, defense on the quarter, we have, I would say, added no new contract in defense. And just a moment here, then you ask defense and commercial. Huh? And commercial, we added the 15 SkyWest that we booked in Q3 on the skylog, on the backlog.
Got it. Thank you. And then I guess just as a follow-up to cash, it looks like you're increasing your cash guide for full year. What about 22 cash? Like how we should think about, that growing off of this 21 base, and is that really just a function of volume and deliveries?
Yeah, we do see for next year also in this range between 100 to 200 million. I don't want to give a guidance right now, but we assuming that we are coming back to, I would say, not pre-pandemic levels, but is slightly below the pre-pandemic levels, we should be able to keep between 100 to 200 million. Because we continue in the efficiency program is not only driven by delivery itself, but everything you are doing in regards to inventory management, purchasing, improving the work capital. We still have, I would say, potential to improve this figure that we are seeing right now.
Great. Thank you so much.
Okay.
The next question comes from Matthias Vimael with Blue Asset Management.
Hi, good afternoon. I think a big part of my questions have been addressed, but just piggybacking on the most recent one, again, just trying to think about your working capital into next year, as I see some offsetting forces. On the one hand, you have fairly low inventory levels right now, and we're seeing increases in a lot of input costs. And to the extent that you see some upside in your potential deliveries next year, I would imagine inventories can be a bit of a drag on working capital. On the other hand, you're seeing better contracted liabilities. So again, just trying to understand perhaps the different push and pull dynamics of your working capital. If you can just comment a little bit on, again, your expectations on inventories kind of going forward, and if you think that can be offset by other work. Thank you.
Thanks for the question, Matthias. And this is a good opportunity to me to share with you guys other activities we are doing. So first of all, our 5-year plan is focusing on the sales of the existing product portfolio. And we do have, as I said before, the potential to almost double the revenues of the company in this period, focusing on the existing portfolio of products. Last year we went through an important right-sizing program in this company, and also we started to focus on important initiatives to reduce the cost of our aircraft, to focus on improving our accounts receivable, and to increase the turns of our inventories. We have the target to almost triple the turns of our inventory turnover in the next 3 to 4 years. So again, I mean, with all these activities to right-sizing the company, to reduce the cost of the products, to reduce the expense, to manage responsibly the SG&A of the company, going to a period of more growth that we expect from 2022 onwards, then we expect that we'll improve our financial performance, either in the profitability and more specifically in the cash generation as well, as stated by Antonio before.
Just to complete, Francisco, Matias, if you ask me today, we continue in the crisis mode here. Means we know about inflation, high inflation in Brazil or worldwide, with the raw material too. We have the contracts backing in regards to pass-through, I would say, and we continue to run efficiencies in our production or back office in order to offset any additional deviation we may have.
Perfect. Thank you very much.
Welcome.
The next question comes from Nicholas Fabian with Jefferies.
Hi, thank you guys for the call and congratulations on the results. Just a quick one here on the rating agencies. After these strong results, the strong recovery, it's notable to us that the 3 agencies still have you on negative outlook. Doesn't seem to make any sense. We actually think that there's a credible path here back to investment grade. So just wondering, what's the latest in terms of conversations with them, timing with the agencies? And then on liability management, you guys mentioned the level of interest expenses and sort of thinking about reducing gross debt. How would potential issuance fit into those plans? Maybe coming back to the market opportunistically with a new 10-year. And specifically wanted to ask around the ESG agenda that you guys mentioned. Clearly, we've seen a lot of Brazilian corporates focused on ESG and doing things like sustainability-linked bonds. So is that something that you guys are already starting to think about? Thank you.
Nicholas, thanks for the question. I start with the rating. We just take, for example, Fitch. We are 1 notch below the investment grade. The last the report of this year, the tendency was negative. They already changed to stable, and I do believe we are going with the new information you are providing. They are going to put in the positive trend, and it's my hope that we get back our investment grade in 2022, most probably end of 2022. That's the first question, and for sure we are in regards to liability management. We are discussing, and Q3 it will be the basis for the debt market to go to refinance our debts and increase the length or maturity level. That's also in our agenda. And these bonds will be a red ESG bond, a green bond.
This
Operator?
concludes today's question and answer session. That does conclude Embraer's audio conference for today. Thank you very much for your participation and have a good day.